February 2007. A loan officer in Stockton, California slides a mortgage application across a laminate desk. The borrower, a forklift operator at a warehouse off Highway 99. 3 years of savings behind him. First home in front of him earns $28,000 a year. The loan is for $340,000. The officer signs it anyway. Then he bundles it with 11 other loans just like it, ships the package upstream to a Wall Street bank, and by the time the borrower misses his first payment, the officer is already at the next desk, signing the next application. 14 months later, a foreclosure notice arrives on a Tuesday morning. The house is already empty. That signature, that one document, on one February afternoon is not an anomaly. It is a node in a chain. Follow the chain backward, and what you find is not greed alone, not fraud alone, not stupidity alone. What you find is a financial system that was structurally designed to separate the person who bore the risk from the person who created it. At every step, someone made a decision that assumed the person at the next link understood what they were absorbing. Almost none of them did. That document, right now, is sitting in a federal evidence archive attached to a bankruptcy proceeding for a bank that no longer exists. This is the paper trail that explains how it got there. Stockton, California, 2002 to 2006. Home prices had doubled in 4 years. Billboards advertised mortgages the way billboards advertise fast food, big number up front. Terms in the fine print, nothing in between. The product on those billboards was called an adjustable rate mortgage, an ARM. The introductory rate, the one on the billboard, was fixed for 2 or 3 years, sometimes as low as 1%. After that window closed, the rate reset. It floated against an index. It could climb. In the mid-2000s, it climbed substantially. The operative word is reset. A borrower signing a 228 ARM 2 years fixed. 28 years adjustable was not buying a stable loan. They were buying a 2-year window and an unspoken bet on what rates would do after it closed. Some borrowers understood this. Many did not. The word adjustable was on the document. What it meant in dollar terms. Over 28 years. On a $340. 000 principal was on no document the borrower ever saw. It was not a calculation brokers walked people through. It was not a concept most borrowers had been taught to ask for. This is where the paper trail begins, not with a villain, but with a vocabulary gap so wide you could drive a foreclosure notice through it. The forklift operator from Fresno had relocated for a warehouse job the year before. He knew his monthly payment for the first 2 years, $1. 148. He knew housing prices had been rising, which meant if he needed out, he could sell. The broker had told him as much. What he did not know, what no one had taught him to calculate, was what happened to that payment when the rate reset from 2% to 7.5%. The answer? $2. 380 in a single month. On a $28,000 annual income. He signed the document. The broker signed the document. The loan closed. And somewhere upstream, a process had already begun that would take that signature and transform it into a financial instrument that neither man in that room had the vocabulary to name. Here is the part of the paper trail that surprises people. The broker had almost no financial incentive to care whether that loan ever performed. Under the originate-to-distribute model that dominated U.S. mortgage lending by 2004, a broker's revenue came from closing loans, from origination fees, from premiums paid for delivering a borrower at a higher rate than they technically qualified for. The broker was not holding the loan. The broker was manufacturing a document, collecting a fee, and shipping the risk upstream. Whether the forklift operator made payments in year 3 was someone else's problem before year 1 was over. This is not incidental. It is the mechanism. When the person creating a loan does not bear the consequences of that loan, the incentive to verify the borrower's ability to repay weakens proportionally. When income documentation requirements loosen as they did, systematically, from 2003 onward, the verification gap becomes structural. A stated income loan, in practice, meant the lender accepted whatever income figure the borrower wrote down without checking it. Inside the industry, people called these liar loans. That name did not appear in any prospectus. That $340,000 loan from the warehouse worker in Stockton was then bundled with loans from Las Vegas, Phoenix, the outer suburbs of Miami, into a security called a collateralized debt obligation, a CDO. That specific loan became Tranche B in a pool of 847 mortgages. And at the top of that pool sat a AAA rating from Moody's. That stamp was everything. Pension funds, insurance companies, foreign central banks institutions restricted by their charters to holding only investment-grade debt were buying these securities on the strength of that three-letter rating alone. The total face value of CDOs issued in 2006 exceeded the GDP of Australia. It was not a niche market. It was a load-bearing wall of the global financial system. What the AAA rating reflected was a mathematical model. Specifically, a model of default correlation, the probability that large numbers of mortgages would default simultaneously. The model assumed that national housing prices had not declined significantly since the 1930s. It was built on historical data that predated the conditions it was now being used to assess. The people building the model knew this. The model ran anyway. In 2006, a small number of analysts began running different numbers. In March of that year, an internal Moody's email later surfaced during Senate investigations showed a structured finance analyst flagging a specific problem. The model inputs for certain 2005 vintage CDO pools had been calibrated against loan performance data that predated the loosening of documentation standards. The loans being rated in 2006 were structurally different from the loans the model had been trained on. The analyst's language was careful, bureaucratic. The inputs were inconsistent with observed borrower behavior in a declining market. Translation: people were defaulting in ways the model said couldn't happen. That email did not stop a single issuance. The analyst's name was not published. What happened to them afterward is not in the public record. What is in the public record is that the securities continued to be packaged and sold for another full year after that email was written. That is the paper trail connecting a laminate desk in Stockton to the trading floors of Lower Manhattan. One signature, one forklift operator's income written on a form no one verified. 11 bundled loans. 847 mortgages in a single CDO. One AAA rating built on a model its own analysts had flagged as broken. At every link, the person making the decision was insulated from the consequences of the decision by the structure they were operating inside. Tuesday morning, March 2007. A letter arrives at a house in Stockton. The forklift operator opens it. His monthly payment has changed, not by a little, from $1, $148 to $2, $380. Effective next billing cycle. Across Stockton, across Fresno, across the Inland Empire and Las Vegas and the outer ring of Miami and Phoenix. The same letter was arriving at the same time. The 2-year introductory windows on the 2005 ARM vintage were expiring on the same schedule, in the same zip codes, to borrowers carrying the same product. Monthly payments were resetting by $800, $1, $200, $1, $500 on incomes that had not changed, in a housing market that had stopped climbing. The exit ramp the broker had described, sell before the reset. Pocket the appreciation, had closed. Stockton home prices peaked in mid-2006 and began declining. A borrower who needed to sell to escape the reset was now selling into a market where every other borrower with the same loan was trying to do the same thing. Supply of distressed sellers rising. Demand from buyers who could no longer qualify for the same easy credit falling. Price is a function of both. Default rates in the subprime mortgage pool began to move. The mathematical models underlying the CDO ratings had assumed that when one borrower defaulted, it did not meaningfully increase the probability that the next borrower would. What the models had not priced was this: geographic concentration, product concentration, and the fact that every 228 ARM in a given zip code reset on roughly the same schedule. The defaults were not independent events. They were synchronized. The model had no language for synchronized defaults at this scale, because synchronized defaults at this scale had never appeared inside the model's historical data window. By mid-2007, default rates in the lowest-rated tranches of the 2005 and 2006 CDO vintages were running at multiples of projections. Losses were migrating upward through the capital structure. The AAA tranches the ones pension funds had bought. The ones foreign banks had bought. The instruments the models had certified as safe were being downgraded. Not to BBB. Straight to junk. Sometimes in a single rating action, over a single weekend. Bear Stearns had 2 hedge funds concentrated in these securities. In June 2007, both funds collapsed. Not slowly. The funds had been leveraged, borrowing to amplify returns, which meant when the underlying values fell, losses exceeded the original investment. Investors lost everything. The forklift operator's loan, now somewhere inside a CDO tranche that no longer had a functioning market price, had traveled from a broker's desk in the Central Valley to a hedge fund on Park Avenue. The chain was that long, and no one at either end had been required to understand what connected them. Here is what the paper trail shows that tends to get buried. The warnings were already there. Edward Gramlich was a governor of the Federal Reserve. In 2000, he proposed that the Fed use its existing authority under the Homeownership and Equity Protection Act to regulate subprime lending specifically, to curb stated income loans, require income verification, and prohibit prepayment penalties that trapped borrowers in loans they couldn't refinance. He brought the proposal directly to Alan Greenspan. Greenspan declined. His stated position: the market would self-correct. Lenders who issued bad loans would bear the losses. They would learn. The originate-to-distribute model had already severed that feedback loop. The lenders were not bearing the losses. They were collecting fees and shipping the risk upstream. Gramlich published his concerns in 2004. He gave speeches. The default rate data was available to anyone with access to mortgage servicer reports. Sheila Bair, then chair of the FDIC, was circulating memos on subprime risk in 2006 that reached the Treasury and the Federal Reserve. A 2006 academic paper documented the statistical relationship between no documentation loan volume and subsequent default rates. It was presented at a conference. It did not change policy. In 2005, the International Monetary Fund's Global Financial Stability Report devoted an entire chapter to the transfer of credit risk from originating banks into the capital markets. The chapter used a specific phrase to describe what was being created: a potential source of systemic fragility. Central bankers read it. Finance ministers read it. No major regulatory action followed. This is what warnings ignored looks like in practice. Not one overlooked memo. A decade of documented concern from inside the Federal Reserve, from the FDIC, from the IMF, from academic economists running parallel to a regulatory philosophy that had concluded, politically and ideologically, that markets were a sufficient corrective mechanism for the problems markets were creating. The forklift operator never read those papers. The broker who handed him the application almost certainly never read them either. But the people who did read them, who had the institutional authority to act on them, and who chose not to, they are in the chain too. Their names are in the paper trail. Their decisions are documented, and the gap between what they knew and what they required the system to disclose is not incidental to the collapse. It is the collapse. September 15th, 2008. Lehman Brothers files for bankruptcy. $613 billion in debt. The largest bankruptcy filing in U.S. history. Filed in the early hours of a Monday morning. By that afternoon, money market funds instruments that millions of ordinary Americans used as savings accounts because they offered slightly higher returns with what had seemed like equivalent safety began breaking the buck. A fund breaks the buck when its net asset value falls below $1 per share. The Reserve Primary Fund held $785 million in Lehman commercial paper. When Lehman failed, that paper became worthless. The fund's value dropped to 97 cents. The announcement triggered a run, not from traders, from people who thought they had savings accounts. The Federal Reserve and the Treasury intervened. TARP, the Troubled Asset Relief Program, authorized $700 billion to stabilize the financial system. Banks that had originated, bundled, and sold the loans received capital injections. AIG, whose financial products division had insured CDO tranches through instruments called credit default swaps, received $182 billion. AIG's failure would have triggered simultaneous payouts to nearly every major financial institution in the world. The counterparty risk was total. The borrowers received the Hope for Homeowners program. It was voluntary. Lenders were not required to participate. Participation was low. Between 2007 and 2012, approximately 3.8 million American homes went through foreclosure. Stockton, California, the city where the forklift operator had signed his application, filed for municipal bankruptcy in 2012. At the time, the largest municipal bankruptcy in U.S. history. Pension obligations, a collapsed tax base, and a housing market that had been the city's economic engine for a decade had combined into a fiscal position the city could not exit without court protection. The borrower who signed in 2007 did not design the originate-to-distribute model. He did not write the CDO prospectus. He did not calibrate the default correlation model or write the internal email that flagged it was wrong. He signed a document he did not fully understand, in a transaction designed by people who understood it very well, in a regulatory environment where the people with authority to require disclosure had decided that disclosure was unnecessary. That asymmetry between what the system knew and what it required the borrower to know is not a side effect of the collapse. It is its architecture. The Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law on July 21, 2010. 848 pages. Among its provisions, the Consumer Financial Protection Bureau, specifically chartered to ensure that financial products marketed to consumers are disclosed in language borrowers can actually parse. The Know Before You Owe mortgage disclosure forms that replaced the previous multi-document closing package were a direct product of this mandate. 3 pages. Clear columns. The monthly payment before the reset and the monthly payment after the reset. In dollars. On the same page as the interest rate, side by side, so the comparison is unavoidable. That information had always existed. The legal requirement to show it clearly had not. Dodd-Frank also established the ability to repay rule. A lender originating a mortgage is now legally required to verify income, assets, employment, and debt-to-income ratio before closing. The stated income loan, the liar loan, is not inadvisable. It is illegal. These regulations exist because the paper trail was followed. The chain of decisions was documented in Senate hearings and court filings and FCIC testimony. And the cost of the vocabulary gap was finally made legible, not in academic papers, but in foreclosure statistics, in a GDP contraction, in an unemployment rate that peaked at 10% in October 2009. The regulation came after the collapse. It always does. Here is what the paper trail leaves behind. A system that structured transactions between parties with profoundly unequal understanding of what was being signed had a cost. That cost was distributed broadly and fell heaviest on the people who understood least. The people who understood most were, in most cases, insulated from the consequences by the same structures that created the asymmetry in the first place. Financial literacy is not a cure for a system that is structurally misaligned, but the borrower in Stockton who understood what an ARM reset meant in dollars on his actual income. In a declining market, calculated on the same page as his rate, that borrower does not sign that document. One different decision in that chain changes the chain. The question the paper trail leaves open is this: why was that borrower expected to arrive at the desk already knowing what no one had ever taught him? And who, exactly, benefited from the distance between what he knew and what the document assumed? The paper trail runs from a laminate desk in Stockton, where a forklift operator signed for his first home and received a foreclosure notice 14 months later, to the bankruptcy filing of a 158-year-old investment bank. From an unchecked income box on a stated income form to a regulatory agency that did not exist until its absence became impossible to justify. The disclosure forms exist now. The ability to repay rule exists now. Whether they are sufficient is a different investigation. The paper trail is there if you want to follow it. Every collapse leaves a paper trail. We follow it. Asterisk. This is historical and educational content only. Nothing in this video constitutes financial advice. Asterisk.